Hi guys, back to class. Today we'll be looking at sources of business finance. My name is Sonia Oluwafemi Akintunde, and I'll be taking you through this part of the course. So we're going to be looking at different sources of business finance. So as an entrepreneur, you may be thinking of starting your own business, but you may not know the type of business, or you might even know the type of business you want to start, but you might not know how to raise the capital for such business. So when we talk about business finance, we are talking about raising capital for a new business or for an existing business, as the case may be. So I'll be taking you through some of the advantages and disadvantages of using some sources of capital. And I hope that by the end of this class, you would have known one or two things which relate with respect to raising capital for your business. So like I always do, we have a learning objective. So at the end of this lecture, students must have a working knowledge of one, the sources of entrepreneurial funds, entrepreneurial capital, or advantages of the sources of entrepreneurial funds. So we look at entrepreneurial funds, we look at the advantages. Also, we look at disadvantages, and we'll draw our conclusion on the best form of capital that is available to every business. So let's jump right into the course. Sources of entrepreneur funds or capital, as the case may be. So the first one we're going to look at is our personal funds. Now, what do we mean by personal funds? So personal funds are usually the money that we have actually saved up, or the money we've gotten from grants or from somebody that it's our personal money, and we want to use it in starting a business. So it is possible that you work for an organization, you work for a period of time, and you decide to start your own business. And part of the amount that you set aside, part of the money you've saved up from your previous business, you have decided, or from your employment, you've decided to set aside a certain amount of money for you to be able to start up your own business. Now, what is the advantages of using your personal money to start the business? The advantages include one of the advantages of starting your own personal business is that there are no strings attached. And since there are no strings attached, you are the owner of the business, and you may not need to charge interest with relation to the business. You may not need a repayment schedule because you are the owner of the business, and you may not need to travel from one place to the other to go and attend meetings with strangers, because you will not need their own funds since you are investing your own money. Personal finance is one of the fastest and easiest ways of raising finance for your business. This involves the owner of the business being the lender and also the borrower, as the case may be. Now, what is the major disadvantage of using personal finance, or what are the disadvantages of using personal finance? Now, one of the disadvantages of using personal finance is you are taking the financial risk, and as such, with financial risk, the outcome sometimes cannot be known. So if you use your personal money to start the business may not be successful and you lose your money, unlike when you are using other people's money to test run the business. Also, you might be dipping into your retirement account, thereby putting your future at jeopardy if you lose the money eventually. That is, if the business is not successful eventually, you might end up losing your personal money. So those are some of the disadvantages of using your personal money in order to run your business, or in order to start up a business. Borrowing from friends and relatives. Now, borrowing from friends and relatives is a viable option when you are trying to start your business. This is usually called love money because it is borrowed, it is given to you by your families and friends. And as such, it is because of the love that they have for you. That is why they have decided to borrow you the money. However, this also has its own advantages and disadvantages. So let's look at some of the advantages of borrowing money from families and relatives and friends. So one of the advantages is that it is very flexible, flexible in the sense that you don't need to obtain any securities in some cases. Since it is given to you by family members, they might not ask you to bring collateral in order to be able to secure the loan, just like you'll be asked if you're collecting the loan from the bank. Though sometimes friends may require you to give them interest, and sometimes you might get interest free on any loan that is borrowed by families or friends, or you get a lower interest rate when it comes to borrowing from family and friends. Another reason is because they are familiar with your character. They are likely to borrow you the money without asking you for a business plan. This is because they are familiar with who you are. They understand what you do. If you are not a serious person, of course, nobody wants to borrow money to an unserious person. So with the assessment of the kind of person you are, your personality type, it is easier for you to obtain loans from families and friends. However, this comes with its own disadvantages, and some of the disadvantages that may arise from the cost of borrowing from family and friend is one. Anytime there is a misunderstanding between the borrower and the lender, there's likely going to be a kind of reputational damage, or a type of relationship breakdown. And relationship breakdown will mean that probably the person wants to recover his money back, wants to collect his capital back, and there's tendency that you may have used that money and may not be able to provide it as at the time the person wants to get his or her money back. Another disadvantage with using money borrowed from family and friends may be as a result of the fact that your family and friends may want to be more involved. They can see that this business is becoming successful, and as such, they want to become part of the business. They want to be making decisions, and this may not sit well with you because in the initial stage of the agreement, I'm sure they were not thinking the business was going to succeed. So they were only thinking, let's maybe borrow this young man the money, is going to return back the money. But with time, they've seen that the business is beginning to boom, and they now see a sense in trying to get involved, trying to tell you what and what not to do in the business. So these are some of the disadvantages of borrowing money from family and friends. Another disadvantage of borrowing money from family and friends may be that they want you to pay interest when they see that the business is, so somebody gives you an interest-free loan initially, but he sees that the business is beginning to do well and it's getting bigger and bigger, and then he comes up with an idea of, no, I've borrowed you this money for a long time. Why don't you give me certain percentage? So that may even bring issues between you and whoever that has borrowed you that money. So one of the advice I give to people when it comes to borrowing money from families and friends, even not only family and friends, when it comes to borrowing money in general, it's always good to have a written agreement so that the terms and conditions of uh, the, 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 the deal, the terms and conditions of the loan or the grant will be stated out in black and white, so that you can have a working document with respect to that. You can always make reference to that. So that is a source and a solution to that particular problem. Trade credit. Trade credit is another source of income. is another source of raising capital, is another source of raising money for your business. So what does this mean? Trade credits is you buying goods from your suppliers on credit and agreeing to pay for the goods later. So it is possible that you have a supplier that is willing to supply you goods and provide you services, and have agreed that after a period of time, of course, you're going to pay him for such goods and services. So with trade credits, it has its own advantages and disadvantages. So before we look at the advantage and disadvantage, also know that trade credits are mostly in the short-term form of investment, because the payback period is usually between a month to less than a year. So let's look at the advantages of trade credits. Now, what are the advantages of trade credit? It is very convenient for the business. It's very convenient for the person that wants to borrow such funds. It's convenient, and you can continue to borrow as long as you pay back at when due. It is also a type of business in which the credit worthiness of the customer is also assessed by whoever that is buying the products or the inventory from the customer. So it is important that you assess the credit worthiness of whoever that is obtaining the credit. And lastly, another advantage of trade credit is that it promotes more sales. Now, not everybody sometimes has the cash in order to make payments as at the time of purchase. But what trade credit does is that it allows you to buy a large amount of inventory and pay for it after you probably have sold that inventory. So thereby increasing your sales, and with increase in sales means there will be what? Increase in profitability. However, the disadvantages of trade credit. Trade credit has a number of disadvantages. Now, what are the disadvantages of trade credit? Now, trade credits can be limited to a specific amount, can be limited. The amount of goods that can be supplied to a person can be what? Limited, because you don't want to supply a whole lot of goods to somebody, and at the end of the day, the goods gets tied down, you cannot obtain your money, you cannot get your money back, and that may become an issue. So there's limits to there's a limit to the amount of credit facility that can be extended to the buyer. Another disadvantage of trade credit is the supplier may not be patient enough to wait for you to sell those goods before he starts demanding for his money. So sometimes lack of patience from the supplier may bring unnecessary pressure on you in order to repay the amount that is owed. Then lastly, regular default in payments may lead to distrust among the parties. So if there is a regular default, if you don't pay for the goods as and when due, and there's a regular payment, the supplier may not trust you going forward, and as such may not want to supply you the necessary goods and services that you may need for your organization to grow. So that's that about credit, about trade credits. There are other advantages and disadvantages, and I would advise you to read up on that and look at other advantages and disadvantages. So the next one we're going to look at now is retained earnings. Now, in simple form or in simple language, retained earnings means undistributed profits. Now, retained earnings is usually used by corporations or big organizations in order to plow back the profits that they have made in that organization back into the business. Now, the essence why you want to plow back is, one, you might be looking at growth. You might be looking at organizational growth, or you might be looking at increase in share price value of that particular company. So that is one of the reasons why a company may decide to plow back its profit or retain profit for the organization. So retained profits, retained earnings or retained profits or undistributed profits has its own advantages and disadvantages. So we'll go through the advantages and disadvantages. So one, retained earnings is a permanent source. It's a permanent source because once you retain earnings in the organization, because it is a retained profit, it forms part of the capital base of that particular company. So for example, when you retain profits in the company, it forms part of the capital base of the company. Don't forget that you don't pay out capital in the company unless the company is going into liquidation. That is the only time when you pay out the capital back. Another advantage of retained earnings is that it allows the organization to grow because funds are internally generated. It allows the organization to have a level of freedom, a degree of operational freedom, because the organization will be able to grow. The organization would have more money in order to be able to do other things. Another advantage rather of another advantage of retained earnings is the capacity of the organization to absorb unexpected losses. Of course, you know, in business, when it comes to business, you cannot predict sometimes with precision if there's going to be profit or loss because you cannot have profit and loss. So you cannot predict if there's going to be profit or loss. And if you are able to retain as much profit as possible, it will help you compensate for future losses when they arise. Another advantage of retained earnings is that it increases the market price of shares of a particular company. And when that happens, it becomes more money for the shareholders. So let's look at the disadvantages of retained earnings. Anything that has advantages will definitely have disadvantages. Now, one of the disadvantages of retained earnings is that when profit is plowed back into the business, sometimes shareholders are dissatisfied. Now, the reason why shareholders are dissatisfied is the reason why they've invested in the company is to be paid interest, is to be paid dividends. And anytime dividend is not paid, it looks like if the company is not doing well. So sometimes investors and shareholders view a company that is paying steady dividends to be doing well compared to those that don't pay steady dividends. So it lowers the interest of shareholders in that particular company. Also, when it comes to retained earnings, another disadvantage of retained earnings is that when it comes to comparing the opportunity cost of such company, you may not be able to compare the opportunity cost of capital with precision because you are applying back the profit that has been made on that particular organization. You're applying back into the business, and as such, you cannot determine the opportunity cost of capital, and this may sometimes lead to suboptimality. It may lead to suboptimality in the sense that you might not judge with precision the way in which the funds are utilized. And lastly, when it comes to retained earnings, certain sources, because of the uncertainty in the business environment, and you cannot determine whether the organization will make profit or loss, then it gives room for fluctuation in profit because you cannot determine how much profit will be made in a particular year, except when the accounts are presented. So if you are looking for a sure or certain business that gives you a specific or fixed rate of returns, then investing in a company may not be the best option because the profits can be fluctuating from time to time depending on the nature of the business. So that's retained earnings as a source of capital. So let's go into bank loans. Now, when we talk about bank loan is a source of getting capital by an organization or an individual. So entrepreneurs with good uh, relationship, with good reputation may approach the bank in order to obtain bank loan. Of course, the bank loan will be given at a specific interest rate, which is expected to be paid by whoever that wants to borrow such loans. Now, advantages of raising funds through a bank loan. Now, one of the advantages of raising funds through a bank loan is that the bank would give you the loan at any point in time in which you need such a loan, in as much as you are worthy of receiving that particular credit. So it will provide it as at any time you require such loan. Another thing is confidentiality. Any information that is supplied to the bank will be treated as confidential. So any information that you provide to the bank with respect to the loan you want to obtain will be treated in secrecy, and as such, you can rely on the bank to keep your information safe. And bank loans sometimes can be flexible in the case that you can increase it at any point in time, and that will mean readjusting the repayment period. And since you do not default in paying back previous loans, of course, the bank would grant you more loans. Disadvantages of using the bank as a source of finance. Now, one of the disadvantages of using the bank as a source of finance is that sometimes when banks give short-term loans, renewal can be very difficult or uncertain. So when a bank gives you a short-term loan, you trying to renew it can be a bit challenging depending on the nature of, though this can also depend on the nature of the person or the organization that it is borrowing such a loan. Also, banks usually conduct detailed investigation into the affairs of any company or person that wants to borrow bank loans. This is because you need to be sure that you have the resources and you are capable of paying back the loan as you disclose. Lastly, bank usually have terms and conditions, which are usually very stringent, and as such, anybody that wants to obtain loans from the bank must be ready to abide by their rules and regulations or their terms and conditions. And these restrictions can sometimes be in terms of you being unable to sell some of your assets that have been used as collateral for the purpose of the business. So you can look out for other advantages and disadvantages of bank loans as a source of finance. So move quickly to bank overdraft. Now, what do we mean by bank overdraft? Bank overdraft is a facility that is given to that is going into current account holders in order for them to be able to uh, withdraw more than what is in their account. So for example, you have, let's say, 20,000 in your account, but you've given out a check to one of your clients. The check is supposed to be for 30,000, or let's say 25,000, and on getting to the bank, what is in the account is 20,000. If you run a current account, you are allowed a certain allowance such that they don't need to give the check back to the client to return back to you. So what they do is they give you an overdraft, and with time you pay back what you have borrowed. So it's a type of facility, it's a type of loan that is given. And don't forget, bank overdraft is a short-term loan. So it is usually paid back within a month to less than a year. And of course, on such type of loans, you are going to pay interest on such type of loan. Now, what is the advantage, or what are the advantages of bank overdraft? Now, the bank overdraft, like I said before, one of the advantages of the bank overdraft is that when you give a customer a check would not bounce due to inadequacy of fund in the account. Of course, the check will be paid out, and that will be recorded as a liability for you in your account. So you are liable to pay that as a future date. It also ensures timely and payments to avoid late payments penalties. Okay, I've just explained that. It requires less paperwork. Yes. So when we talk about a bank overdraft, there might not be a lot of paperwork that is involved in getting a bank overdraft from a bank compared to getting long-term loans from a bank where you have to provide collateral, provide other information and documents that may be necessary that may be necessary in getting the loan approved. Bank overdraft is also a facility that is very, very flexible and can be taken at any point in time. However, it has its own disadvantages. Now, some of the disadvantages of using bank overdraft is the high interest rates that comes with bank overdraft. So, bank overdraft to be given to a customer, but you have to pay an interest rate, and usually the interest rate is usually higher. Also, there's the risk of seizing incoming funds. So if you already have a liability in your account, you already have a debit in your account, anytime money comes into the account, that money can easily be substituted for the liability that you have incurred previously. And bank overdraft, like I said, sometimes can be secured against inventories of an organization or other collaterals, as the case may be. So what that means is that they might secure, they might grant you the overdraft, but in security with inventory, such that you cannot sell certain assets, you cannot sell certain things that have been used as collateral as part of what was used in granting the loan in the first place. Then we have public offering. Now, public offering is the option that is available to well-structured companies. So usually it goes to PLC companies, well-structured companies that are listed on the Nigerian Stock Exchange. So it's a way of raising capital from the public. So sometimes we say we're going public. When you hear a company saying we are going public, that means they are going PLC. That means they intend to raise capital from the public. They intend to ask the public to come and subscribe to the shares of that particular organization. Now, what is the advantage of raising capital from the public? It enables shareholders and other suitable investors to invest in that particular company for a high return. Also, it enables payment of dividend to shareholders, although this payment of dividend is not compulsory. Like I said, sometimes the profit of the company can be retained in the company in order to ensure that the organization grows. Also, equity is a permanent form of capital and can only be repaid back during liquidation, when the company is going into liquidation. Now, the fact that you have shares in a particular company also guarantees you voting rights. It enables you to have a form of control since you are a member or you own a percentage of that particular organization. Now, what are the disadvantages of raising money through public offering? So anything that have advantages will definitely have disadvantages. Investors who want steady income would not prefer public offering, because the truth is you don't know what the turnover of the company might be for the year, and as such, their uh, their dividends or profits are always fluctuating. So if you are a person that you're looking to invest and you're looking for a steady income, the public offering may not be the best for you. Also, when we look at disadvantages of raising money through public offering, now the thing is, a company can decide to go back to the market to raise more money. And what does that do to your own shares? What happens is, at the end of the day, the shares of the initial shareholders become diluted. and as such, voting power too will become shared among those new investors. And so sometimes it can be very challenging for other investors. Then the process, lastly, the process, the formalities, the procedures involved in public offering sometimes can be very cumbersome, and as such, it can be very challenging for companies that are into public offering. So lastly, we'll look at bootstrapping, bootstrapping finance. Now, bootstrapping finance is a type of finance which involves you using uh, easy ways, cheap ways in order to run your business. You being creative in different ways in order to reduce the cost of running a business. That's what we call bootstrapping. Now, what are those things that you can do when you're doing bootstrapping? So bootstrapping is a person that starts a business because he does not have the funds to put every necessary things in place. He is the CEO, he is the accountant, he is the engineer, he is the recruitment officer. So because of that, it engages the services of temporary staff so that the wage bill is lower. It leases assets instead of buying equipment. It leases those equipment. You might have fewer staff. So all these are methods or ways in which you can reduce the cost to the barest minimum. Now, what are the advantages of bootstrapping? One of the major advantages of bootstrapping is that you don't have to spend time looking for investors. You don't need to go up and down looking for loan or looking for family and friends to borrow you money. You can use whatever you have and try as much as possible to be economical with it. Also, you have control of the company and you are not answerable to anybody. Just like when you have angel investors investing in your business, you might need to answer to them. But in bootstrapping, you are the CEO, you are the owner of the company, you don't need to answer to anybody. You just need to be creative when it comes to managing your money. Also, with no funding, you learn faster, more efficient ways of running your business, and this forces you to be what? Creative. And most times, companies that goes through uh, bootstrapping most times are usually strong, efficient, and have uh, great customer base. They are customer focused company because they came from the ranks of the lower cadre and built the company to becoming big uh, organization. So because of that, they must have learned a lot through that particular process. So let us look at the disadvantages of bootstrapping as a source of finance. One of the major disadvantages is you don't have access to capital. You don't have access to large money. So you cannot even expand beyond your capacity. So most times, if you want to start companies such as manufacturing companies, importation companies, oil and gas companies, may be difficult because you don't have the resources and you may not be able to compete with other people within the same industry. Another disadvantage of bootstrapping is that it will take you a longer time to grow because you are minimizing your funds, you're minimizing your costs, you're minimizing your and such, you'll be minimizing your profits as the case may be. Another one is that you may not be earning enough money because the size of the business may not be too wide, and as such, you may not be earning enough money in order for you to grow. Then lastly, you can easily end up in a lot of debts. So for example, where you are deciding, okay, I want to do this on my own. Because of that, you are now acquiring debts. At the end of the day, you might be ending up with a lot of debts on your neck. So in conclusion, we have looked at a number of sources of finance. However, you know that at this point, the source of finance you choose will be dependent on the type of business you want to create or the type of business you want to run. So if you are looking at source of finance, the type of business you want to run, the amount that is involved, the repayment period, all these will come into play when you're thinking of the best possible way of financing your enterprise. So as usual, you have an assignment here outline 4 sources of finance not stated in this presentation. So I expect you to give me 4 sources of finance that are not stated in this presentation. Question 2 says that you should explain venture capitalists and venture capitalists as a source of fund. So venture capitalist is a source of funds. I intentionally did not talk about it here. So you have to explain to me what venture capitalist is as a source of fund. Then venture capital as a source of fund. Then what is the difference between venture capitalist and angel investor? So you tell me the difference between a venture capitalist and an angel investor. Lastly, the following example, a source of funds, except which of these of the following is not a source of fund. So thank you very much. As usual, failure is the ability to start again more intelligently. So, and mindset is what differentiates ordinary from extraordinary people. Numbers don't lie. It only shows pattern. If you study for 30 minutes every day, you cannot compare yourself with somebody that studies for 3 hours every day. Results would always show. You can reach me on any of the social media platforms. If you have any issue, please subscribe and click the like button for more content. Thank you very much. And I hope to see you in the other course.